Okay, well, welcome everyone, and thank you for joining me and for signing up for all of the great presenters that they have with these events. It's a great way for traders that are new, traders that have been in the markets for a while, to sort of discover maybe new techniques you want to learn. If you're starting from the beginning, where do you start? So the topic that I'm going to be presenting today is on. This is the third one that I've done in this series for them. And so I sort of planned these out in a particular order. And the one today is going to be on day trading the S&P 500 futures. The first one, I went over an introduction to a powerful trading pattern called the AB equals CD. And if you registered and signed up for this, then you should have received a PDF with article on this particular pattern. So the next one that we did was on the very important psychology, discipline, and time management of trading. And so the third one today, we're finishing up with some sort of real world kind of trading, bringing this all together. Now, I'm going to be posting all three of these on my blog soon. So if you'd like to be able to access those, and make sure you join my email list at my website. I think it's always important for traders to think about whether trading is suitable for you. There is risk in trading, and also, your risk management that you develop with your trading plans is very, very important. Some of the portions of this are excerpt from a full 12-hour course I have called Mastering Trading with Pattern Recognition. It's on my website. And then also from a book that I wrote with Larry Pesavento, Trade What You See, How to Profit from Pattern Recognition. And all the materials, these are all for educational purposes. And you do need permission to do any type of copying of these materials. So this, here's the books right here. Right now it's in these languages, and we're working on getting it in Spanish right now. I'm not going to spend a lot of time on the pattern structure because, as I mentioned, that was a previous webcast, and you should have the PDFs for that pattern. When we get to some of, I'm going to go to my live charts today after we go through a few slides, and I'll be I'm able to kind of draw in some patterns as we go. So hopefully you'll be able to catch on with that. So first of all, I am Leslie Jouflas. My website's Trading Live Online. I've been in the markets over 25 years, trading, developing trading strategies, helping traders learn pattern recognition, technical analysis, and develop their own trading plans that they can work themselves. They should be very individual. But let's get started with just a quick overview. If you're brand new to futures, I'm going to give you the website that you can get more detailed information, so we don't spend a lot of time on this and away from the charts where we want to be today. But the S&P 500 futures is really a great day trading or even a swing trading vehicle. The S&P 500 mini has two contract sizes now. There used to be three. The big contract was delisted in 2021. So the S&P 500 E-mini, it trades at $50 for a full point and in increments of a quarter point. So you have a quarter, a half, and 3/4 of a point up to that full $50 point. And then in the last few years, they've come out with the S&P 500 Micro E-mini, which is a great contract size to trade, especially in these volatile markets. You can really help to control risk by using this contract. And you can always leverage up to more contracts. So this also trades in increments of a quarter point, half, 3/4, and a full point, but it's $5 per point. I'm going to show you some examples of using the micro mini on my live charts of, some potential recent price targets that could have been achieved with this, and you'll see what I mean. So the futures contract is really something that trades in the future. And with the S&P 500, the futures contract is on the underlying the S&P 500 index, and that index holds 500 of the largest cap countries in the United States. So instead of analyzing 500 stocks, you're using one index. I think it's a huge advantage to just do your technical work on, the one main index that you're trading. Of course, you could always add in individual stocks to your portfolio if you like, but for trading purposes, I think this is just one of the best vehicles. It is one of the most liquid and most traded futures contracts that there are. It's important if you're new to futures to keep in mind that futures are what's called a zero-sum game. For every buyer, there is a seller, and that's important to know about trading futures. So here's where the hours that they trade. You guys can look at that, and they pretty much trade continuously. And then down at the bottom here, I have the contract months of futures markets all the way from January through December. The ones in blue, these are the months that the S&P 500 trades. Since we do trade into the future, we're currently trading on the September contract right now. So here's the CME group. This is where you can just Google CME Group, Chicago Mercantile Exchange, and you'll come up with their website, and they have tons of information on futures trading, on different contract sizes. So you can really educate yourself on what goes into futures contracts. But one of probably the basic things you should know is the volume. The volume is the number of contracts that are traded on the selected date for all the CME Group venues, Globex, Open, Outcry, all of these. And the open interest is the total number of contracts, either long or short, that have been entered into and not yet offset by delivery. So each open transaction has a buyer and seller, but for calculation of open interest, only one side of the contract is counted. Now, open interest can be used in a couple of different ways to kind of add into technical analysis. Increasing open interest represents new or additional money coming into the market. So that can tell you that there's new interest coming in, either on the bullish or the bearish side. And then decreasing open interest means that money is flowing out of that market. So the interest is decreasing in that market, and that can be the sign of possibly a turning point. It could be a consolidation, but it could be a good technical tool to learn how to follow. Okay, so now let's start to get into some basics of trading. Emotions are part of your trading. I'm sure other presenters have mentioned that. Anybody who's been trading knows this firsthand. I know it, 100,000 different ways over 25 years. And I'm a huge believer that it is your trading plan that is going to be the thing that brings you balance. But before you can get to a trading plan, you have to think about a couple of things. You need a lot of different skill sets that need to be each one approached separately and studied and learned, and you get a good foundation in it, and you start to blend them and bring them all together. Trading is not just one thing. So I've listed out here, several things that are part of those skill sets. The first thing you need is your method or approach. So you say, hey, I want to trade the S&P 500 futures. That's where your focus should be. Don't be running around to every other market. Just put your focus onto that market and commit to learning it. Each market has sort of a different character, personality to it. And it always requires some mindset skills, which each different thing that you are studying. So maybe one market is better suited for your mindset than another, or time frame. And then you have to decide if it's technical or fundamental. The ones that are highlighted, these are the ones I use. I am a technical trader. I'm a CMT, I'm a chartered market technician. I studied technical analysis for years and years before I decided to go after my CMT designation. And it's a great program. It takes about two to 3 years to get through three very rigorous exams involved. But I'm a discretionary trader, but I use a mechanical approach to my discretionary trading. Technical analysis skills, this is a broad skill set, and it takes time to learn technical analysis, to how to read chart patterns. Your routines that you develop are essential. My routine is very basic, but I do it every single day about the same time of day. And I'm basically looking at open, high, low, close, the previous open, the previous close, what market environment are we in, range versus trend, consolidation, uptrend, downtrend. So I want to know where to put my finger on the pulse of the market. So it only takes me, not even 5 minutes now to go through my routine. However, it did take me time to develop it. I do help traders develop their routines so that they can develop a trading plan as well. But again, this also has to fit into your mindset skills. And timeframes, combining timeframes, I think is a big technical analysis skill to learn how to do. And then, of course, you have to eventually develop a trading plan and have a method to test that plan. Testing the plan not only is going to give you an indication if what you are applying to the markets has any chance of being profitable over time, but it's also going to tell you if it's suited to your mindset. And these are areas that you probably could use somebody who knows how to help you. And of course, your risk management, this is very much related to your mindset skills. Now, a lot of things traders don't realize also is execution skills of that trading plan. If you don't have a trading plan, your execution skills are probably never going to get better. But this accounts for the majority of your bottom line. How do you handle drawdown periods? This is a mindset skill. This is related to your trading plan. How do you handle periods of large winning streaks? A lot of traders don't realize how important it is to understand this with your mindset. This can tip traders over into a state of euphoria, which is actually a dangerous mindset place to be. And how do you handle trading errors? If you don't have a trading plan, you don't know what your trading errors are. So just a few things to kind of think about. Now I'm going to quickly, because I want to get to the charts and I don't want to come back at the end, but I put a lot of time into thinking about the best materials and the courses that I have put together over the years to offer you for this topic and for the mindset skills and all that. So I put together a couple of courses. I have a day trading S&P 500 E-mini course. It's approximately 8-9 hours. This tells you what it covers. Here's some lovely testimonial from a student of mine, Terry Pittman. So you can come back and you can study what's on here. It's a very good course. And I decided to add to that the introduction to pattern recognition so that you can also have a strong foundation in learning specific setups that you can apply into either the S&P, any market you want, any time frame, actually. And then I also, these were videos after doing the trend day course. I would see things as if I would be sitting and I'm trading, and I would see things that would happen related to that topic. So I sort of on the fly would just turn on my screencast and I would record videos on the topics related. And so there are 12 of them that are related to those topics that are really going to help strengthen your skills. You can see the special price here. It's going to expire July 1st. If you have questions, email me. If you think you're going to be interested at the end of this information, just go back and type in this URL. It'll bring you to the sign up page. Okay, now let's get to the fun stuff. Okay, charts. So trends. I'm going to show you first these charts of a few of the big tech giants that have been leaders in the markets. Now, these were first put together for stockcharts.com. I do a segment for them called Your Daily Five a couple times a month. You can go look it up. There's a list of segments of mine you can follow if you like. But all the way back in April, before any of these trend lines were broken, we identified this pattern. It's an upward trending parallel channel, and Apple had been within this range, still in an uptrend. Uptrend we can just define as higher highs and higher lows, but now it's broken this lower trend line here, and has some retracements on here, but the trend on this time frame has turned to the downside. So there's been a rally back to the upside, almost retesting this. I can get another test up, and I wouldn't expect Apple to be going to any new highs anytime soon until we see another change of trend back to the upside. But this is AMAT Applied Materials and the semiconductor. The semis were showing weakness early this year. Here's an outline of the type of pattern we're going to be looking at. The markets do three things. They go up, they go down, they go sideways. When they go sideways, they form coiling types of patterns. Eventually, the price comes out of these types of patterns. We want to be able to identify what precedes a trend. You cannot see a trend in foresight. You can only see a trend in hindsight. So the better we can increase our technical skills into identifying the conditions that precede trends, the better chance we're going to have of entering a new trend early, which is the goal of a trader. This is a skill that you want to get good at. So I've got this outlined here with the kind of lower trend line, the upper trend line. It broke to the upside. We can take measured moves of these types of patterns and project them up for price targets. This one just almost made it, may have felt just a bit shy. This actually formed a reversal pattern up here at the same time. And we can see how this long bar brought us back into this range. That's just not a good sign for a continuing uptrend. And from there, this market has now been breaking more support and trending to the downside. So Amazon, really interesting chart on Amazon, very strong uptrend, 2009. This is there's different types of uptrends. Some are very tight like this one with kind of shallower consolidation type of patterns. Here's a A, B, C, D pattern. That's the one that's in your PDF. These appear in trends and ranges. This is a continuation pattern of the trend. You can see this nice tight uptrend here, shallow corrections. Here's a longer term trend line that's drawn in. Back here again, back in 2018, here's the lows at 2020, breakout to the upside, a larger ascending triangle continuation pattern, break to the upside, and then look what it did here. Look at how tight this coil is. This is a monthly coil. I think of these as like sticks of dynamite. When you see this type of pattern, this is a type of pattern that can precede trends. This is a trend continuation type of a pattern. We could probably scale down to smaller time frames here and start to see some patterns on small time frames that preceded this portion of the trend from the 2009 lows. But this trend line is going to be important for Amazon. It's gotten close to testing it here. It hasn't broken it. This chart is just from yesterday, so it's pretty current. So you want to be watching this 100 level of Amazon, and keep in mind that it's already broken out of this extended multi-year sideways coil pattern on the monthly chart. So there's two examples of patterns that precede trends. And here on Facebook, changed to Meta platforms now, we see a similar type of pattern. We see the uptrend. We have higher highs, higher lows, higher highs, higher lows. And then we get into starting to consolidate this. And again, sort of an upward ascending triangle, breakout to the upside, and then back, look at the long bar, back into this pattern. I find that I keep a lot of once I draw trend lines and things on my charts, they tend to stay there forever because it helps me to identify where the important price levels are, support and resistance. Now this pink dashed line here, this is representing about the halfway mark of this very large downward candle. Many times price will come back up and retest that 50% point. We can see here with the break of this lower trend line that this bar came up, almost got there, didn't have quite enough strength, was sort of testing this lower trend line as well, and turned, and now it looks like it's got more downside on Meta Facebook chart. Microsoft was in a very long coil from the end of 2009. It went into a 7-year sideways range. The prices were down between like $19, $20, $25. It just stayed in that range. Nobody wanted it after that 2009 crash. And well, now everybody wanted it up here, and that's just kind of human nature. But it's another example of how long a sideways range can form. I have examples of charts from 100 years ago where they formed very long extended sideways ranges and then finally broke into one direction or another. And that's a condition that precedes a trend that has the potential for preceding a very powerful trend. So again, we can see here, we see the market does three things. It goes up, it goes down, it goes sideways. So this, we've broken a longer term trend line here on Microsoft, and you can see the retest on this rally and then more move to the downside. I've got some Fibonacci retracement levels here from the 2020 lows to the highs. It's reached the 0.50. If it breaks this 0.50, then it's likely headed down to around this 0.618 retracement. There may, however, be a B, C, D extension buy pattern forming. Now, again, I wouldn't expect that pattern to bring Microsoft to new highs, but it might be a good swing trade for retracements back to the upside. Okay, and Google, similar thing, like Google formed the sideways pattern up at the top. So as a reversal pattern, this acted as a reversal pattern and now a trend to the downside. So we see the expansion phase and the contraction phase, and those are two phases that the market does. It does expansion and contraction. Once it's in a contraction phase like this, it's going to eventually come out into an expansion phase. Now, the last slide here before I go to my live charts for you is this is we want to get an overall view. So if S&P is the market we trade, we want to look at different time frames and get an overall view of the market, because there can be trends that can occur on one direction on a longer term time frame, but your short term time frame may have a trend in the opposite direction. Maybe it's doing an uptrend within a longer term downtrend. Now, this pattern started tracking on my monthly subscription weekly market setups back in January and February. And we were charting the development of this pattern. It's a large head and shoulder reversal pattern. It has broken the neckline to the downside. The measured move targets for this are in the green, this green dash line, which is coming down close to the 50% retracement using the March 2020 lows to the highs in early 2022. And this area is also coming back into a previous area that was once resistance and now may act as support, but that has to be monitored as the price comes down. Now, I have an updated chart on my live chart, something I'm going to show you of this. But what I wanted to point out is technical analysis is sort of it's a fluid motion. It's not static. So back here when we first started tracking this rally to the upside, I thought this might have been a weak right shoulder, weak, W-E-A-K. So in other words, it wasn't broadened out, and that can happen in these patterns. But where these trend lines were drawn in, they held, and we had another rally to the upside. So I moved where the right shoulder was after this peak completed and started to turn down. And that's where we could start to see that the trend lines were starting to break on that. And these are, some indicators that I use with trends, RSI, a MACD, and an ADX. And these are what I call the three amigos, and you learn about those in that course. Okay, so I am going to, now that we have an overview and we're going to update this chart now, I'm just going to escape out of here so I can get down to my live charts. And I've got a few set up. So let's start now with a look at the monthly SPX. I'm using the SPX here. So we can get a little bit longer term view of where we've been and where we are. So again, the 2020 lows up to the highs early this year. So now we see from that head and shoulder pattern on the weekly chart, we can see these levels here of these were support levels that have broken to the downside, has had some retesting, but now we can clearly see that the market has traded to that first 382 retracement, and it's closed slightly under it. This leads me to believe that we have a good chance of getting at least to that 50% level. We have some weakness on our RSI. Our MACD is showing some momentum lows. So that gives us a pretty good overall picture. Now let's scale down to a weekly chart. So now here's the updated SPX weekly with our head and shoulder. I put on here, when you're a trader, Jesse Livermore was probably one of the best traders that ever lived. He was, you can read about him from the early 1900s into the 1920s, the 1929 crash. He was famous for that. But one of his quotes was, "It's not the bull side nor the bear side, but only the right side." So if your technical analysis kind of is bringing you to the right side of the market, you're on the bearish side when you should be on the bearish side, you're on the bullish side when you should be on the bullish side. That's what he's referring to by that. So let's sort of update now where we are. So on the SPX weekly, so this is the cash market. So the monthly chart, I think, was the SPY chart. So it's a little bit different in price. So we can see a little more detailed view here of, where the price has been. Here's the head and shoulder pattern. There were actually 2 points to draw a neckline. One was horizontal, one was a downward sloping. We can see with the break of the horizontal, a retest of price back to that level. And then from there down to the 0.382 retracement, and then a rally back up right to that. This is why I don't usually take trend lines off of my chart. This had been on here for quite a while and extended out. I didn't draw this on after the fact. This was drawn on before so that I could see price heading back up towards that level. So in my work, part of my routine, this is part of what I want to go in and be looking for. So I know this is a resistance point regardless of a big long bar. Look at that big long bar, but it wasn't able to get any traction above where this anticipated resistance level was. So the trend is turned to the downside from this uptrend. We no longer have a pattern from these lows up of higher highs and higher lows. We've broken that pattern now, and now we're starting a pattern of lower lows and lower highs. So there's a couple of trend lines drawn in here. So this trend I'm expecting stays to the downside until it has enough strength to wherever that's going to be, get back up and break back up through some important trend lines. Now, depending on how price proceeds, there may be more trend lines that are drawn in, but that's just the basic thing that I'm looking at that's keeping me on this. We're still in a downtrend. We're still in a bear market until the price gives us enough evidence that it's not the bull side nor the bear side, but only the right side, that we're going to be back on that right side of the market. Notice also here on this break, this gap area here, notice how that gapped below that 382, this should be a support level that was already tested. And price has been spending the last few days retesting this 3,800 area. If it does get up through it, then we still have this gap close on this monthly chart, should below that 3,900 to contend with. And even on a bit stronger move, then we'd be looking for about the halfway point. So your technical analysis and writing down these price levels of your support, your resistance, sort of thinking when I was learning to ski, I had a great ski instructor, wanted to learn moguls, and he could float down the hill with champagne glasses, balanced on his shoulders, and they would be there at the bottom of a mogul hill. Me, one ski over here, one over here. Anybody see my pole? Whole different story. But he taught me to look ahead. Leslie, look down the hill. Don't be looking straight down at your skis. Look down the hill. Look 4, 5, 6, 7 moguls down the hill. And so that's sort of what my approach to technical analysis is as well. Okay, so now let's go and take a look at another time frame. So we looked at monthly, we looked at weekly. Now let's take a look, work our way down. And I'm showing this to you guys in that order, but I tend to actually go from smaller to higher lots of times. That's just how I do it. But I think starting out doing it higher to lower is usually how it's taught. Okay, so now we're looking at a chart of the S&P 500 futures daily chart. So we looked at the cash market, we looked at the SPY, they're all related. And you can trade the SPY, as well. So if you don't want to trade futures, but you like this market, then there's other vehicles that you can use to trade it. So here, first of all, let's back up a little bit. Let me see if I can, again, this retracement. Well, let's just do it this way so we don't scrunch it. The low of this retracement is from about the March 2020 lows. That's the reference I'm using right now. So up at the highs back here, late December, early January, there's what's called, and you'll learn about this pattern in the course materials. You'll know it thoroughly at the end. This is what's called a butterfly pattern. It contains an A, B, C, D, and the D point extends above that previous swing. But these can be very powerful reversal patterns. They're not always this powerful. Sometimes you get a nice retracement. Sometimes they fail and they keep going with the trend. Sometimes you'll see a succession of them form. But when you start to see a condition like that happen, you have to be paying attention when that same pattern keeps forming over and over and over again, and you start seeing it across the indexes and then across ETFs and then across individual stocks. Like the things we just looked at on those tech giants, there were all warning signs up at the highs. And if we scale down to many of those charts, previously we were identifying with those for my subscriber base, these types of patterns that were forming early. So this is a reversal pattern, and it obviously, the market reversed after that pattern. And then from there, I just have some other patterns. So here's a counter trend pattern. Now this is a butterfly buy pattern. This one got a retracement up, a retest, and then did make it above that high, but it didn't do anything like what this one is now doing. Then we came in and formed a larger kind of ABCD buy pattern. We had this reaction to the upside. We're going to scale down to this section here in just a minute. And then it wasn't able to rally any further. But look where it went. And again, these trend lines were drawn in advance. So these were sitting here when the price came up and was like boink, 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 boink. Couldn't get through there. I need to kind of extend this one out more right now because we want to keep that extended out in time. So we know that this is still a resistance area until it's not. We can see this trend line, this upward sloping trend line here coming up, and we can see how much play, price got around that price level, testing, 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 long candle to the upside. A lot of traders saw that it was bullish and thought we're coming back up to new highs. And the bear market word wasn't really out there in the public yet, although, we were seeing it with these patterns that were forming, and then a quick reversal the next day. And you can see it broke that as support. It broke this pink support line as well. You can see the test. So I hope you're getting the idea of you get your finger on the pulse of the market. You get very good at identifying support and resistance. I teach like 7 methods, simple methods of identifying support and resistance. And then you combine that into your routine and I have, you guys remember what paper and pen is? I have a notebook, paper and pen, and I write these things in it every day. So I want to write down what was the high of the day, the low of the day, what was the opening price, the closing price. And I also want to know what the previous open and closing prices were. And I'm going to tell you about that when we scale down here. So just a little bit more on this. So we know that we've gotten to the 382 twice. The second time it came down, it broke the support, and it's just been hovering around that level in the last 1, 2, 3, now day 4. The market hasn't really had a huge bounce. It's only bounced about 150, 160 points, which we have ranges, 1-day ranges that are almost that large. So in 4 days, it really hasn't made a lot of traction to the upside, but it has gone into a bit of a contracting range the last couple of days. So we're going to be looking for expansion. Okay. Oh, wait a minute, last point on that. So if we from here, or maybe it's able to pop up here, but look at all this resistance here with this gap, we turn back to the downside, take these lows out, then this 50% level is going to be the next level that I would be looking for, 3,500-ish level right around there. Okay, so now we've looked at the monthly, weekly, daily. We've gotten, I think, a pretty good idea of patterns and where the market is and where it might go. We never know. Price can do anything. So, as a technical analyst, you also want to keep an open mind as to direction. We don't want to get totally locked in where we can't change our analysis or opinion when the price is now telling us a different story. I always like to look for, well, first of all, look for these types of levels, support, resistance, and then kind of play off of those. But I want to be flexible, as well, because I've gone through periods where you get convinced of something. That's a mindset thing, and you're going to miss out on some important moves. So we don't want to really be doing that. Okay, the next thing chart I want to pull up is going to be keep getting these little squares on there. I don't know why. They're kind of annoying. Okay, let me see. Come on, there we go. All right, so here's a 60-minute chart. So now we're scaling down to an intraday time frame. And you can see I've got all kinds of little lines, hash marks, and things around in here. So let's kind of look at this. So on my charts, what I tend to use is I tend to use a combination. I use a combination of time frames, as you can see. And I also use a combination of types of charts. So this is a bar chart with candles on it. And the candles can help us see, battles between the bulls and the bears. We can identify some of those long, wide-ranging candles. We can use those as support resistance, monitor price action against them. We can see gap areas. So the bar charts with the candles, the regular time frame, I do not put Globex session on. When you have Globex on, you're not able to see these gaps. And these gaps in price levels can be very important when the price is doing corrections back up, retesting levels. It gives you a wonderful opportunity to see how price is reacting to those levels. And many times you're also going to be able to find trade setups around those areas. Okay, so here is the area I was just pointing out on that daily chart where I said, it was, you see all those opens, closes all around that same area. Well, this is what it looks like on a 60-minute chart. So we can see here that, remember, we want to find types of setups or patterns that can lead us to the starts of a trend. We want to try and find out what precedes a trend. We don't want to be finding the trend, this short-term uptrend. We don't want to find it here, but remember, for every buyer, there's a seller. And so, someone bought this. Here they are. I should have a little Wile E. Coyote face up here with his little dynamite about to go off the cliff, because that's sort of what that reminds me of. So somebody bought it, someone sold it to them, and somebody bought it. So, it's a zero-sum game. And then down we go, and then into this long consolidation, never quite back to the high of that bar. So this is a coiling type of a pattern. And I am just going to actually draw in a couple things here. I'm going to put in just one more little bit lower trend line. So we can frame this in using the highs and the lows of the pattern. And another trend line that I like to use with these is the center line. Now I just eyeballed that in, and I've been doing these enough of these that's probably right about there. It's probably just about 50%. So you have 50% above and 50% below in this pattern. Well, what tends to happen in coiling patterns like this is the market, you can see here it had moved to the downside, then sharp move up, sharp move back down, sharp move up, resistance around that center line, sharp move down, sharp move up, down, more play around that center line, sharp move up, sharp move down, sharp move up. And this is how you can start to early identify that you might be going into a coiling pattern when you get sharp move up, sharp down, sharp up, sharp down. It doesn't go anywhere. And in the meantime, on the daily charts, you're starting to see opens and closes around that same price level. That's also a sign that the market is going into a coiling phase. Contraction and expansion. The coiling phases are the contraction, and then the trending phases are the expansion out of that. So in this particular pattern, you can see that all the times that center line was traded. Up here was another center another coiling pattern back here. And this center line actually extends way back to some other price levels that were back in the history of the price, and then also came forward again and retested those levels. And so you can see how this center line became almost the high of this coil that started to form. And this is why I don't tend to take my lines off, even though some of you might be going blind with them. I tend to keep them on as a reminder, oh, wait, there's something there at that price level. What is it? And then I can go back and look. So we can see from this center line, the market came to the downside, had another down move, and then back up, retested, and this started to form this coil here. You can see how many times that center line was formed, and then finally retested, and then moved and broke to the downside. And the last thing I want to point out with this chart, so this was the trend down, this was the powerful move down out of this coil. These types of coils give us an advantage also, because we can actually get what's called measured move price targets. That's one method. There's other methods. It's just one. And it may go farther. It may reach it and turn around, or may not get there at all. But this particular one was 39.47. So you had about, let's see, if you did the breakout from there, you had about 120 point, close to 120 point move down out of that range. So on the micro mini contract, that's $600 a contract. So, for those people that say, oh, you can't make any money on that. Well, that's not true. You have to look at the setups, the market environment you're in, and what types of targets and things that you're using. Now, the last thing I want to point out on this chart before we move on is the FOMC days tend to precede some large moves. Sometimes they're going into the FOMC days, but oftentimes after FOMC announcement, the announcement day, there'll be a strong move in one direction or the other, because I think, some of the big funds and pensions and things are digesting what actually happened, how that's going to affect the markets, and then they take action on it. Notice also how this lower line here, finding this support, broke support, now it's resistance, how this is now an important price level for the market to get through. But here is the FOMC. This is the low to the high of that day. And then the next day we reversed to the downside, and then this big gap to the downside. So I have this trend line drawn coming this way through these lows here. It's intersecting with this price level. That's telling me that there should, which is a four-letter word in trading because we don't want to get locked in, the price should find some resistance, which it has been doing. But if it also breaks through, that can give us another set of information to work with. So the lows and the highs, those spike, they almost always get a spike low and high on an FOMC day. You get a wide ranging looking bar like this. So generally, when the market takes out, as it did the lows, you're going to get a continuation to the downside from that, because there's a lot of stop losses placed there. And then same thing on the upside. So now if this price were to come up and be able to close above this high, notice how this high close and this open on this bar are almost the same place. So that gives us about 38.25 on the price to be watching for resistance, a close above that, and should be able to get traveling back up into this gap area and maybe retest these highs, maybe the lower portion of where that measured move was. So you see how you can sort of put the pieces together of just doing some kind of it's basic technical. For me, it's basic technical analysis. For you, if you're starting out, there might be something that you really need to be studying as one of your skills to be able to trade. I want to find somewhere on here. Let me go to the 5-minute chart first. And then I'm going to go find my 20,000 tick chart so you can see what that looks like. So my tick charts that I use always have Globex. My regular bar charts always have the regular session so I can see those gap areas. So here I've got this last swing here. This is from the FOMC high down to this low. No, just a little tick there. I should adjust that. There we go. So I can see how these retracements to the upside using this Fibonacci ladder are reacting. And so I can also see here, so we know that we know from what we just looked at, there was resistance in this price area, right? Using some longer term time frames and scaling down. And so I can see it now on my 786 retracement. I can see boink, 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 boink. It's been hitting those levels. So the next level, if it gets above, is going to be this 886 level. And this is what I call the last chance fib retracement. Generally, if it finds good resistance and turns down, that tells us that's an important price level. However, if it's hovering around here and gets a close above it, then it's likely to get at least to this 1.0. And many times it will exceed that and get up to the next fib level extension. And you'll learn all about that in those courses as well. But right now you can see on the 5-minute chart that we've got somewhat of a range going here as well. We had this move from the lows up here. We can see this day trading. Oh, the other thing I keep track of is, did the market trade from low to high, or did it trade from high to low? Has it traded low to high multiple days? Is it ready for a break, or vice versa? And so I keep track of that too. And there's patterns within tracking those types of very simple things. It takes me less than 5 minutes to do and just take a look at. But yesterday was an outside day. So that means that the price traded the low to the high within the previous day's range. And now if we get an inside day, if we don't exceed the high here and we don't exceed this low today, then we may have an inside ranging day where the price is within the previous day's range. And that is also telling us the market is in a congestion, it's in a contraction phase, and it's going to come out of that, even on the short term. Okay, so we can now sort of mark in. We'll just kind of put in a couple of different levels here. So I'm seeing these lows right here. I'm seeing these lows. You can see how it got up here, tested, got through it, test again, test, 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 test. So I want to be aware of this level here. And then I also want to be aware of these lows because there's a gap right here. So if price were to break this level to the downside, we already looked at the upside, but now if it breaks to the downside, my expectation is it's going to be coming down to at least test somewhere around these lows. And from there, we want to determine, are we now forming a larger range? The answer is going to be, if it just breaks those lows, then no, we're going back down. Or if it holds it and we come back up, then we're going to watch this as our center line and see how price reacts. And we have our highs mapped out. Okay, so I hope that's making sense. Because remember, we're looking for conditions that are preceding the larger moves. Okay, now I'm going to move a couple charts around. Oh, good. I only had to move one because there's like 100 underneath here. So I just pulled out the ones I wanted for today. So now let's take a look at the tick chart in the last few minutes that we have. We've got about 3 minutes. I think we can do it. I'm not going to go through the entire thing. I just want to show you. A sec, I think I need to spread this out. Okay, I'm going to spread. Okay, here's the section I want. Okay, so over here, here's that coiling pattern that we looked at. Why is this not moving up? Okay, here's the coiling pattern. This is now in a 20 20,000 tick chart. So the tick chart does not use time to fill the bars. It uses ticks, up ticks and down ticks. It's a 20,000 tick chart, so it needs 20,000 ticks to fill a bar and complete a bar. So here is the range here. And within this range, we have all kinds of ranging patterns that we can trade. A, B, C, D buy pattern down to the support, retracement up, another little A, B, C, D buy pattern here. Here's A, B, D sell pattern. Here's a little triangle pattern. This was actually the first clue, this triangle with the break to the downside, that these lower levels might have broken. So you can also learn to study what happens inside of these ranges, and you'll get kind of good at anticipating the direction that it's going. So here we can see, here was the break of it. And so you can use the measured move for a target that was, around, like I mentioned, around 100 points. Now, depending on your trading plan is going to depend on how you're taking exits on this type of a setup. And if you don't have a clue, you don't have a trading plan, you're just putting yourself in danger for a lot of different reasons. So there's many different ways that this can be traded. It can be traded with multiple contracts. So you're scaling out a sum, you're trailing a stop. If you're holding one contract, you can have a method to be trailing it down and have an exit method based on that. So anyways, it's not just a one size fits all. That size has to fit you. That's the most important thing. So here, down here at the lows, we had a ABCD sell pattern and a head and shoulder pattern. So this head and shoulder pattern broke the trend line for another 60-point target to the downside. And then it formed this coiling pattern at the lows. That was a 74.5-point range. And so that had the breakout to the upside. Here is the measured move target on it. So, and again, if you're just looking at the micro at $5 a point, I mean, you have, 100, 160 points, 100, and so you have about 250 points just based on contraction and expansion. Okay, so I am exactly at my time to stop. If you have questions, I'm not able to get them today, please email me. I show the slides of what the trend course is and what's included with that. It'll be up at the beginning of the video. If you want it, email me and I'll just send you those slides and you can look at it or ask me any questions. So thank you for joining me. I hope you found some information in here that is going to help strengthen your trading skills, and best wishes for successful trading. And I'm Leslie Jouflas with Trading Live Online.